Welcome to Bar Charts Market and Close. I'm your host, John Rowland, Bar Chart Senior Market Strategist. So, in this part of a show is where I usually do a punny introduction about today's segments, but in lieu of market activity, I want to get right to our segments. Some of the narratives have changed from our preparation, and others I think are a little bit more pathetic today. So, hopefully, we'll get some extra time for your questions, and always here to help me out is Twitter Tom, my Mr. X. Thomas. Hello, Thomas.
Hello, John. How's it going?
Pretty wild day today, huh? I don't know if you've been watching markets, but it was kind of feel like it was putting out a lot of fires today.
Yeah, it felt, John, to me in my bones like things were getting just a little bit too easy for everybody, and maybe today sort of is a wake-up call, huh? For
I agree with you 100%. Yeah, for sure.
All right. We got a jam-packed show, John, as you said in the intro, so I just want to give everybody a quick reminder. If you're watching directly on our website, you want to ask a question, just click Ask a Question at the top right. You'll see it in the orange color. And if you're watching on our various social channels, guys, just go ahead and ask those questions directly in the chat or leave a comment. And John and I will get to as many as possible. All right, John. So there was an interesting stat I saw, John, which is how the U.S. stock market is doing relative to the rest of the world. And not so well. And, some people might be surprised by that, John, because the S&P has done remarkably well this year. Tech stocks have done remarkably well, but the rest of the world is doing even better. And there has been some talk about whether we should divest some of our U.S. stock positions, John, and maybe look for exposure elsewhere. How do you feel about that?
Yeah, Tom. So, this is something I've kind of been planning or I've been researching and actually thinking about is I think it is time for us to start thinking about diversifying our portfolio, especially if we want to look for opportunities or alpha outside of the U.S. And so this really makes a lot of sense to me. Hopefully, it'll make sense to you folks. And let me just start by saying is that let me pull up my chart here first. Is one of the reasons why I want to diversify out of U.S. right now is because if I'm a passive investor, through my retirement funds, the top 8 stocks in the S&P 500, you can see them here: NVIDIA, Microsoft, Apple, Amazon, blah, 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 blah. And we look at the top 8 in the NASDAQ are exactly the same. So that means if you're passive investing, you're literally double dipping on these 2 stocks. So that's another reason why I want to diversify outside of the U.S. Now, what I find interesting is when we look at the largest companies in the world by market cap, and we look at the top 25. Now, I'm just going to scroll down here, but I want you to notice here on the right side, all U.S. companies, Saudi Arabia, that's Aramco, there's Taiwan Semiconductors, Chinese, Korean. Not until we get down here to the Netherlands, which is ASML, which is another semiconductor company, does it get to 28. So that means 25 of the top stocks in the world none of them are European stocks. So I'm thinking that maybe might be some opportunities for investment in this space. Now, what I did is I created a watch list here of European companies. And let me see if this works, Thomas. But I'm going to share the watch list in a link here for our viewers. But anyways, so let's look and see the stocks that are in here. And I'm going to sort these here. And I'm going to go into our main view here, and I'm going to sort these by fundamentals. Notice I'm going to sort them by market cap. So there you go, the ASML, Prosus, SAP, Novell, Hermes, L'Oreal. So if you're not familiar with some of these companies, Prosus is a online e-commerce. SAP is a software company. Novo, obviously, is a pharmaceutical. Hermes is a consumer discretionary. L'Oreal, another discretionary, although my wife would tell me that this is a necessity. Siemens, automation, telecom and electrical, and there's Airbus there. Okay, so let's look at this from a performance standpoint now, and I'm going to go to a 50-week performance, but I really want to look at 52-week versus 3 months, because remember our theory that stocks that outperform for 6 months tend to outperform for a year, and those that outperform a year tend to outperform for another, 6 months to a year. And so we can see the top of the list here is the Spanish bank, Santander. You got Airbus, and then there is Proceus, Sanfran. This is an eyeglass company, Siemens Financial. So, there could be opportunities in this one. So what I want to do is I want to step away from the performance and let's look at this from the technical aspect. And what I'm looking now here is at our bar chart opinion. And our bar chart opinion is based on 13 technical indicators. And so if you have 100%, that means that you are giving a common interpretation of a buy signal in all 13 indicators. So look who kind of jumps to the top here. So we got Siemens, Airbus, Schneider, right? Sanfran. Now, notice that, ASML does not get 100%. It's right there at around 80. I'm going to discount that one because I don't want that exposure to the semiconductor space because I already got it heavily through the U.S. So let's talk about, a couple of these companies. So first of all, Siemens. So if you're not familiar with them, they're an automation software company. They're in building technology, right? Airbus, obviously, we know that is aircrafts. Schneider Electrical. So Schneider Electrical is an electrical parts, infrastructure, metering. For my tin hatters out there, they also are into something that's called energy tariff optimization. What the hell that means, I don't know. But these two, Siemens and Schneider, would be closest to data center build-outs in Europe. And then just below that, I'm going to skip over the eyeglass company, is Safran. And this is a multinational, multi-corporation conglomerate, and they're in the aerospace. So they make jet engines, multi-grade optics, radars, and they're going to benefit from defense spending. Now, if you're not familiar, that one of the deals that the current administration did with NATO countries is that they're forcing them to spend more of their GDP on defense spending. So a lot of the defense contractors in Europe have done very, very well. So you can probably see that in this one as well. And then the other one that fell out of 100 today because of what the market has happened was this Proceus. And this is an internet commerce company that is international throughout Europe, India, and South America. And I want you to think about this company as like you're going to get DoorDash, you're going to get companies like DoorDash, Carvana, eBay, Etsy, buy now, pay layers like Affirm. They're different companies. They're European companies. And for my tin hatters out there, now they also are into what is called carbon credit utilization monitoring, whatever that means, and educational training. So you get this conglomerate of international internet activity. So I think that's the 4 companies that I'm going to look at, Thomas, and look for trading opportunities for those. I'm not maybe going to rush to buy in here, but I certainly think in that spectrum of what we've been thinking about outperforming here in the U.S., I think these are categories or industries that will probably continue to outperform over the next 6 months to a year.
All right. Great segment, John. I know a lot of people are very NVIDIA focused and Tesla focused and Apple focused, but guys, there's a big world out there, a lot of different opportunities. Even if you don't want to go fully into any particular country, John, there can still be some gems that can help somebody's portfolio out.
Yeah, exactly.
All right. So let's jump from Europe to crypto, John, which I know is one of your favorite subjects. So big news. S&P is launching a top 50 crypto index, John. This is going to be comprised of 15 major cryptocurrencies, obviously Bitcoin, Ethereum, Solana, Ripple, and then 35 crypto-linked stocks in one investable benchmark, maybe Coinbase, maybe your favorite MicroStrategy, John. Who knows what those are going to be. But what do you think are the implications or the major takeaways from this?
Well, first of all, this is an index and it's not a tradable instrument yet, if I'm correct, right?
I think to start, correct, and then eventually, I think the goal is to make that uninvestable index.
So what this is going to do is it's going to provide for us um, an instant measurement or performance of these crypto 50s, the 15 coins and the 35 companies. So I think what this could be is it could become a measuring stick that could create FOMO, greed, and fear. Because you think about how this might play out, and this is what I'm going to be watching for, is, right now, if crypto moves, like a crypto coin moves, Bitcoin, let's say, goes up or down, the algorithms will pick up on that, and then they will trade, let's say, the crypto related companies, for instance, like, one of these crypto platforms, or, the miners. So there's kind of this ripple effect. And I'm wondering if this is going to have a multiplier effect. In other words, if Bitcoin goes down 2% and then you see a 2% drop in all of the stocks, are you going to see a 4% drop in the index, right? I mean, and that could create a fear, right? It could create a fear that folks will not look at an individual stock or look at it, look at an individual crypto coin and just look at the index and say, oh, the index is down, 5% today or 3% today. Could that create a fear? So I'm going to be interested in watching this index and see how it measures up in terms of the relationship to the coins on a day-to-day plus or minus, and what the index does. So that's kind of where I'm at with this one, Thomas. Again, I think it's interesting. I think it's another tool that is going to be very positive for us. But, I want to see how this tool works before I make a comment on it.
All right. And then kind of going into a more specific crypto, John, is big news in the Ethereum world, which is Grayscale. Grayscale is the first ETF issuer to add staking to its Ethereum ETFs. Now, little history lesson. In September of 2022, Ethereum moved from proof of work to proof of stake. And in doing that, they actually created a huge benefit for token holders, which is to allow them to earn passive income by staking their coins. Now, we're not going to get too technical here, John, because I don't think either one of us is an expert on this whole technical aspect of crypto. But basically, staking is the process of locking up your coins for a certain amount of time. In doing that, you help Ethereum secure the network and validate transactions, which is, of course, necessary for the Ethereum network to operate. But here's the major point here, John, is you get interest. Now, when Ethereum ETFs first launched, and we got a question about this on MOC, there was no staking. So if you're a big institution, if you're a bank, if you're a hedge fund, John, with millions of dollars to invest, you're missing out on 3 to 5% income. That's a huge deal when you have deep pockets. Now that this is mixed in or baked into the ETFs, man, I consider this a pretty big deal, John. And it may not show up right away, but I think over the long term, I think this is really positive for Ethereum.
So the way they kind of explained it to me, so I just want to clarify for our folks, is this: it's kind of like a CD, right? You have your savings in a bank and you put it in a CD for 6 months or whatever, and then you earn an interest on it, correct?
Yeah, exactly. That's a great easy way to explain it to a lot of people.
Okay, so there's two questions I have to ideas or questions I think is, first of all, is what is the penalty if you say, oh, I loan my coins? Is there a penalty, or are you locked in and you can't get to your coins? So that would be the first question. But the second question I want to ask you is, I think this is kind of, like you said, this is kind of a game changer. And does this idea that these altcoins, in this case ETH, can create income, in other words, intrinsic value, that's always been one of the knocks against Bitcoin. Could this be the catalyst, or the crossroads, so to speak, of where we might see monies flow out of Bitcoin and into some of these altcoins that have this? Is it proof of work? Is that was correct? What's your the staking point idea?
Proof of stake now.
Proof of stake. where they could create income, right? Could this be a dynamic shift or a tectonic shift in the crypto space?
So to answer your first question, I think when the staking first launched, now I'm not talking about the ETFs, I'm just talking about the Ethereum network. There was a hold up period, a lockup period where if you staked your Ethereum, you were required to hold it on there for a while. And I don't think there wasn't even an option to take it out, John. So penalties, no, because they just didn't allow you to take it out. That's changed. So now I think it's the case where there are no penalties. If you want to stake for a short period of time, go ahead and do that. If you want to stake for a long period of time, go ahead and do that. Just remember, you do have to pay transaction fees. So, depending on how congested Ethereum is, John, that can range from a couple dollars to a couple $100. So keep that in mind when you're about to do this. I don't see this as something that's going to challenge Bitcoin's dominance, John. I think Bitcoin is always going to remain the major player in the space. I think it's become really ingrained in our society. But I do think that this is a positive for Ethereum, and Solana also has staking ETFs. It's a positive for Solana. I think it's very helpful for them over the long haul, and I think it's going to result in boosted returns as opposed to if we didn't have staking ETFs. But do I think somebody like Michael Saylor is going to cash in his Bitcoin, John, because Ethereum launched a staking ETF? Absolutely not. And there's no sure thing in the markets, John, but I'm extremely confident that Bitcoin is going to retain its dominance and be the major player in crypto for years to come.
Yeah, I'm not talking about Michael Saylor, but I'm talking about, maybe like your low-level institutional trader who's made a lot of money in Bitcoin. This is a good excuse to diversify your portfolio, especially if you're going to get, a nice dividend. Now, again, I think you made a good point in our preparation meeting was like, hey, are you going to buy a utility that's going to give you 4% interest when, you're a growth ETF? I mean, you want to be in these growth stocks. And there's a big difference between owning a utility and owning, let's say, an NVIDIA. But here's a chart of ETH versus Bitcoin. And this is kind of what I'm saying, Thomas, is look, this is the ratio. And so if the chart is going down, that means Bitcoin is getting stronger in terms of that ratio. And if the chart is going up, that means ETH is getting stronger. And notice that we bottomed just recently this year at a historical low level. Now, notice those two red candles. The second red candle is where the last time ETH turned up in this relationship to Bitcoin. And you can see the lines here this is a weekly chart. This is a 40-week moving average. This is a EMA and a SMA. So we get a crossover the EMA over the SMA, and we're also seeing now that the price or the ratio is above. So to me, market looks like it's already kind of starting to price this in, and that'd be interesting to see if this does not return to some of those peak values that we see that were back in 2021, 22. And I know you've told me this, that we are entering into a altcoin season. Is that correct?
Yeah, well, I think we're still waiting for that to begin. It hasn't happened yet, but this is generally the season for that. So I'm still expecting that. And yeah, I do think, John, last I checked, Bitcoin dominance was sitting at 60%. So that's Bitcoin's market cap divided by total crypto market cap.
Right.
60%.
That'd be the inverse here.
Yeah. Now I do think that will come down, right? When altcoin season begins, yes, people rotate out of Bitcoin. They rotate into more riskier assets so they can potentially capture outsized gains. So I do think that's going to be a short-term event, John. Over the long term, though, I would be really surprised if, the staking aspect sort of erodes or eats away at Bitcoin. I think we're going to continue to see this oscillation as we see on the chart right now.
I think we both can agree at this point is just that this isn't a major event, and maybe this could be the catalyst that does benefit some of these altcoins in the short term. So let's leave it at that, okay?
Perfect. All right, John. So let's talk about silver and gold, which we've talked about many, many times. And I know our audience, John, they're probably going to be like, "Oh, you guys have said this looks bearish before," but it's been just on an incredible run, John. I mean, I just can't believe what I'm seeing. Again, guys, for those of you not following our last show, we talked about the monthly RSI hitting historic levels in gold, John, and it looks potentially like something may have changed. What did you notice in the charts?
Yeah, again, when I was doing this, setting this up at the beginning of the week and setting it up for this morning, what I was going to talk to you about is about a certain type of candlestick, and this is called a bearish kicker, and that would be this one here. So let's kind of move this so we can see this. And then when you think about candlesticks, right? They're very subjective, and you gotta have them in the right context. And if you're going to find a reversal pattern or a reversal candle, you want to make sure it's at an extended, trend, which is exactly what we have. So this was looking like a very dominant type reversal pattern. Now, in a bearish kicker, when you get the second candle, you usually get a follow through, right? You usually this is kind of a sentiment indication that you're going to see follow through for the next 2 or 3 days. But you could have a little bit of a pullback or brush back in this case. And so you can see here that, the green candle for today is up. Now, for most of the day, we were below. And with the purple line at this 4,017 level is 50% inside of that bearish kicker. So if we close above here, which is, I think, the futures market is closed, but it still trades up until, I think, 4:30. Then what we might get is a negation of this candle. But again, it's certainly telling us that there's this shift in momentum and sentiment. Now, if you were a part of my show on Wednesday, our educational webinars, we looked at Heikin Ashi. And so Heikin Ashi looks at candles a little bit differently. It's a modified Japanese candlestick. And when you see wicks above and below, and you see these doji-like candles, this is telling you that there's a change of momentum and a change in market sentiment. And so there you have a dominant uptrend, and all of a sudden, boom, you get this little change. Now, the rules here are very rule-based. In other words, at best, the best thing here is it's just telling us that this trend has come to a pause. But at worst, right, this could be a reversal. This doji is telling this could be the setup for a reversal. And so what we need to see is price to fall below that doji. In other words, close below another candle. So that is a little bit away. Now, the other thing we looked at have in the past, and this is a tease for next week, is we're going to look at Trend Seeker, which is one of our proprietary tools. If you go to bar chart templates and you scroll all the way down to the bottom, there's something that says a long-term stop template, and there you can see these green lines. So the green lines here are these, green dots. Green dots. This is telling you still have an uptrend, and we're still above it, and not until we fall below those green dots could that be a change in your trend. So this is really telling us stay in the trend, don't worry about it, and you can use this value down here around 38 as a level of a stop. Now, one of the other things that we looked at in Wednesday is that former controlling candles can act as levels of support and resistance in Heikin Ashi. Now, notice this purple line here. If I change this back to Heikin Ashi, that would be this candle here where we paused the last time. And so, notice that comes in right at our Trend Seeker spot. So that means that that's going to be a level of support. Now, for those of you who say, oh, this is all fancy schmancy stuff, and I don't really care about candlesticks or Heikin Ashis, maybe you're just more of a fundamentalist or traditionalist. Well, here is our moving averages. And you notice that our purple line where TrendSpotter was located is also our 20-day moving average. So Thomas, just kind of sum up here on the gold is, I think we're probably gone too far too fast. We said that last week, and this is really kind of telling us, what looked like a setup earlier this morning. Now, I think the market has kind of bounced back because of what's been going on, with the tariff situation. But just telling me that, hey, we're overdue for a little bit of a mean reversion. And that mean reversion would put us somewhere down around this 38.48, 38.50 area. And I think that's normal. And I think that would be a good thing. Plus, you said you wanted to look for a buying opportunity, and that might be that buying opportunity.
Yeah, I've been waiting a long time for that one, John.
Yeah.
All right. John, let's talk about retail. And the reason we're going to specifically talk about this is I saw this from Morgan Stanley over the last month. Now, guys, hold on to your chairs when I read off this figure. Over the last month, retail investors, John, have pumped $100 billion into the stock market. That's the largest 1 month retail buy in history. John, when you see that, especially with the stock market just at all-time highs and everybody's saying a correction is due, what are your thoughts? What is your takeaway from this?
Yeah, I mean, we always talk about how, retail traders tend to buy the tops and sell the bottoms, and this might be a confirmation of this. I just want to kind of give you kind of a personal reflection on this one is that, since the rate cuts from the Fed, my portfolio on many days, it had some very huge gains. As a matter of fact, there was one day where literally every thing in my portfolio was working. And that's not usual. Usually when you get, a big update, all the growth and the high beta stuff works, and the defensive stuff usually goes down or stays unchanged. And what happened is you have like this, what is called like a one correlation day. I mean, not only in the equities markets, but in the metals and, and some of my futures and stuff like that. So it was all positive. And so a one correlation day to the downside is usually a deleveraging event. So that's not a good thing. And we did see one of those back in April. But a one correlation on the upside, that is a leveraging situation. And that is telling me that, that, like you said, there's this kind of this exuberance, right? There's really no fear in the market. And when we talked about bubbles last week, one of the other things that you can talk about bubbles is that one of the characteristics is that greed turns to the form of profit reinforcement or reinvestment, and that traders become very overconfident and believe that the trend is never going to end. So, rational risk aversion is replaced by this kind of this enthusiasm or this euphoria, and that's usually a sign. So again, there's something that I was thinking about in terms of my personal experience and this idea of this over rationalization in the market. And what you've done is you've proven to me that in this space, it kind of really reinforces that idea that retail really rammed into the market here in the last 3 weeks or so.
Yeah, I mean, when you have a market, John, that just feels like it just goes up and up and up, and retail has been buying and buying and buying, overconfidence will set in at some point, and I think people will think to themselves, you know what, these corrections, these bear markets, this is a thing of the past. We've seen this previously, John, but it's going to come at some point. It will come at some point.
Right. And certainly today has that feeling that something in particular might be happening, right?
All right. So, John, on our last show, we talked about the government shutdown and potential impact on the stock market. And we said, if it's a short-lived shutdown, probably nothing to worry about. But the longer it goes on, the longer it lingers, perhaps then some pain will set in, because again, the thing that the market hates the most is uncertainty. Now, we talked on our last show, John. This was from Kalshi, okay, prediction markets. Last time, John, the expectation was 14 days, and now that expectation has almost doubled to 27 days. And I think you have some interesting numbers to share, John, about what kind of pain could potentially set in the longer this lingers on.
Yeah, so internal data from Bank of America and also PNC says that about 60% of U.S. households live paycheck to paycheck. And this would be the first bi-weekly paycheck. That's how government employees get paid, that they're going to miss. The other one was that 25% of households spend 95% of their paycheck on necessities. So that's not a good thing as well. But there were some government reports that came out just recently, one by the Small Business Committee, which says there are 6,800 plus government contracts that represent over $300 million per day in financing, loan financing. And the Small Business Association said that many of the small businesses that rely on government contracts, anything less than 30 days in a shutdown, it will probably just be an inconvenience to them. But beyond 30 days will start being something serious to them. And then most of these companies, these small business companies, only have about 45 days of line of credit. So when we start thinking about this in terms of what you're just saying, if we get out 30 days, 45 days, then this much to do about nothing that we thought 2 weeks ago that turned into an inconvenience now is turning into something serious in terms of impactful and consumption and economic activity. And so I think, you add all these things together and plus what happened today, it really kind of tells me that there's a lot of things that are kind of poking at, so to speak, that bubble.
Yeah, agreed. And hopefully this doesn't last that long because, obviously I don't want my stocks to go down, but more importantly, I don't want to see people run out of money and lose their jobs.
Suffer, right? Yeah,
it's things get bad when that happens. So.
Yeah, this started to get serious, right?
Yeah.
Okay.
All right. I think that wraps up our main show, John. Great job as usual, guys. If you guys are watching on our social channels, if you liked it, please give it a retweet. Leave a comment. Tell us what you liked, what you didn't like. I know John and I always appreciate the engagement from everybody who shows up for these shows. All right, John, ready for some Q&A?
Yeah, I am.
All right. First question, John. When you're assessing a stock and it looks to you like it might stop or potentially reverse, do you mainly look at the Fibonacci retracement levels or do you look at something else?
No, Fibonacci is more of a confirmational level. I still believe in the old school. You don't look at support and resistance. You look at very specific swing lows or swing highs, depending on what we're looking at, and those that correlate with weekly lows, monthly lows, multiple month lows. So, that's mostly what I look at. I also like to use Bollinger Bands because I think Bollinger Bands kind of define the range of probability. So if I find when the market falls into, a lower band, so to speak, and that lines up with, a monthly low, and then we get a little bit of a bounce off of that, then that, to me, that would be a sign of support. If that happens to also fall on a Fibonacci line, that just gives you more confidence. And so that's one of the things that I look at. So what I want to find is these clusters of, converging evidence. And so for me, like Fibonacci is more of a confirmational value and not necessarily a single standout value.
John, do you look at ITB or XLI at all? Because we got a question from Richard. I pulled up ITB really quickly. It's the construction index, and then XLI is the industrial ETF. So Richard's question is, ITB, the construction index, appears to be the first leg to drop, showing weakness in the overall economy. Do you see that potentially the same way, or maybe something else is going on?
Well, I think we can think about, we talk about, Dr. Copper as being sort of a measuring stick of economic activity, right? So we can certainly look at that. But here, pull up my chart here. And I know that folks maybe not realize this for today, but also in the oil market today, we also got a big drop. The oil market went down $2.50. So, oil is the blood of economic activity. So if Dr. Copper is, let's say, the measuring stick for economic activity, then crude oil is the canary in the coal mine for recession. And so this is very significant to me that we're seeing a fall in crude oil prices. Now, could we look at, let's say, some of these economic indicators, or like you said, this industrial one? Yeah, I think that's a great way to kind of look at that those leading economic indicators that could tell us there's a change is underfoot in the economy.
Let's see, John, any comments or opinions on the rare earth minerals based companies?
Well, this whole thing, I don't know if folks don't know, is that there was this pushback from the Trump administration that China sent out this very detailed report, says that they're going to constrict a lot of rare earth production, and they're going back on some of the promises that they made. So, I think there is a lot of implications for rare earths. Now, when we looked at LAC, I think it was a couple of weeks ago when the government took a piece of it. They are creating rare earth lithium in Nevada. So I think this is going to become a scramble where folks are going to start looking, where am I going to find rare earths? Where are they going to be developed? And how we can get China out of that supply chain. But until then, this is going to make it a lot more difficult for some of your AI plays, aerospace plays, to continue without this confidence in the supply chain.
John, can you please comment on the end of the road screener for bar chart? He sometimes sees a stock pop up in the result of that screener when the market is open, but then is gone later on.
Yeah, sometimes what happens is the screener that he's talking about is if you go into investing under bar chart screener, and this is one that I created that just looks for stocks that have been in a very strong uptrend over a certain period of time, and then gap down, a gap of 2% or more. Now, notice there were no end of the road candidates here. So watch the webinar on it. But what happens sometimes is in the pre-market, right, at around 8:30 in the morning, 9 o'clock in the morning, when the screener is starting to digest all that information, you might see a stock, especially a small cap stock or a low volume stock, that looks like it's going to open lower, it's going to gap lower, but then when it opens up, it opens up at say unchanged or something. So that's why you might see it on the list like at 9:30 in the morning, but then it disappears. So that's probably just a statistical aberration.
Okay, just going through the questions here. Okay, here's an interesting one, John. If the shutdown continues and we are not able to get economic reports that a lot of people rely on, how do you think that could impact the market?
Yeah, well, we use economic reports to give us clarity on where we think the economy is going to go. So if we don't have that clarity, that creates uncertainty, and bingo, what does the market do when it has uncertainty?
It doesn't do well.
No, it doesn't like it, right?
All right, let's see here. Does it matter if the Fibonacci retracement levels are reversed with the reverse check mark? Does the 100% go on top or the bottom? I don't understand. I don't understand that.
Yeah, I think this is the way you draw it. So if you're drawing an up Fibonacci, right, you want to start from the bottom to the top, right? There you go. I mean, I just did it. I don't even know what was going to happen. But look at this. The last low that we made back in July versus our recent high. What is our low today? See, that's more of a confirmational level. If I was looking for a buying opportunity and I saw that today, that would give me confidence that this dynamic sell-off that we got today was really just a buy a dip opportunity. but that's the way you do it, right? So whatever, if you're going from an uptrend, you want to start from the bottom and go up. Always think from left to right. That's the way I do it.
This is a good one, John, because you think you wanted to talk about this a little bit. Do you think OpenAI's investment in AMD will have a meaningful long-term impact?
Yeah, this is a bizarre story, Thomas, right? I mean, I hate to use the word Ponzi scheme, but it's like, oh, hey, I'm going to give you money, and then what you're going to do with that money is you're going to buy my chips. Oh, and by the way, this other chip company is going to buy into your company, and then you're going to buy their stock, and then, right? It's just kind of a way to inflate revenue, inflate sales. It seems very, very bizarre to me. So again, one of the things that happens in bubbles, and I'm not saying this is fraud, but there are a lot of weird fraud or accounting issues that happen at tops of bubbles, and this is the weirdest of the ones that I've ever seen in my history of trading. I don't know. What do you feel about it?
Yeah, I mean, in our prep, we talked about this a little bit. I just think there's a lot of tech companies out there, John, with cash piles that are just unfathomable, and they're just trying to figure out we got all this money, how do we use it? And I think they're just trying to deploy it in ways that might generate a return for everybody involved.
So again, is that a well executed expenditure of capital? I think Buffett says something about this. It says that a lot of times companies think they might be doing the right thing, but they're actually doing the wrong thing, right? They probably should be better saving that capital to do for something else, or something that is a more noteworthy project instead of just pumping up relative companies, or even their competitors. It seems very bizarre to me.
Yeah. John, why are silver miners down while silver is at recent highs? I would be surprised if silver miners. I have not looked at this.
Yeah, I have not either.
But gold miners, as we talked about a few weeks ago, gold miners are performing at a heck of a lot higher level than the underlying commodity.
Right.
So again, I would be surprised if silver miners are actually down.
The only thing I could guess is that there is a lot of silver already out of the ground. It's less expensive than gold, and so maybe, and also I don't know the fundamentals of silver mining. Maybe it's maybe the cost is a lot more compared to the price of the commodity, whereas like the cost for like gold, let's say, I was told there's the mining cost for 1 ounce is about $1,800. Well, if the gold is trading 4,000, that's a huge profit. Well, what if the cost to gold, for silver is, I don't know, $30 or something like that, or $40, right, an ounce? That could be the reason why you're not seeing the silver market doing as well as the commodity price.
Yep. Great point. John, this is going to be the last one for today's show. Your feelings on natural gas. Should we be buying or selling?
Well, again, natural gas, again, I wanted kind of to do a segment on this one as well, but, again, the dynamics of that changed a little bit. Again, one of the things I told you to look for is go into our futures, and if you're going to look at natural gas here in the U.S., look and take a time out and go into European prices here and look at what is called the Dutch TTF. This is the LNG market of Europe, and look at that in terms of what it's doing. This usually has a direct correlation to what's going on with U.S. prices. Now, I told Thomas in the beginning of the week, it looked like it had been range bound and it was setting up for a breakout. And we were thinking about doing a story on. Now, this is actually here is Cheniere, LNG is the stock, Cheniere. And you can see how they have a high correlation to what is really going on in the TTF, not necessarily what is going on in natural gas. Natural gas had a nice run. We talked about you had to get above a certain price. It got above there, got a little bit of a run. Again, look at weather. this next week is going to be kind of normal weather, but we are getting to that seasonality. We just had that one seasonality as we roll over from summer to winter. Contracts usually is this between now and Thanksgiving usually kind of drifts off. And then after Thanksgiving, if we get real weather, in other words, cold weather, then that's usually a good time to buy natural gas.
John, we got one final one. It's just a quick one because we got this the week ago. Tools for spotting breakouts and reversals. So we actually have a page for this, John, under investing, and you can go and look at that. And then you can also, run your own screeners as well with your own filters, guys. And John, you just did a webinar, I believe, on breakouts and reversals.
Yeah, I did. I think I'm pretty proud of that one. I think it's a good one. So we're out of time here, but go and check that one out. You look at Bollinger Bands, you got RSIs. We look at a lot of other technical indicators that we can enhance potential breakouts, reversals, and all these different setups. So you get 6 different setups here.
Perfect. All right. Great job, John, as usual.
Thanks, man. I appreciate it. Hey, folks, Thomas and I can't thank you very much for spending time with us. I hope you guys enjoyed today's session. Today was a crazy day out there, and we've talked about having a plan. And, the time to set up a plan is not when you have one of these big days. So make sure that, every time you enter the market or when you are managing, you manage your risk. The best of health and the good of all trading.